You ever notice how two people at the same tech company can make the same money, but one ends up with way more wealth? It's not luck, it's not who got the better promo, it's tax planning, the most underrated cheat code in tech. If you work in big tech or even at a startup, taxes aren't just that annoying thing in April. They're a core part of your wealth strategy, and once you understand how your equity gets taxed, everything gets easier. Your choices are more clear, your money goes faster, and your stress level drops. So let's walk through how this all plays out in real life scenarios. When you work in tech, your income is weird. You're not like the average employee getting a simple W-2. You're getting stock that vests on a recurring schedule. Stock options you can exercise, shares in your company from the employee stock purchase program, bonuses, and each of those gets taxed differently, which means the people who win aren't the ones with the biggest compensation, they're the ones who understand how tax rules work, and nothing shows this better than RSUs. Let's say your RSUs vest next month, and the value is $100,000. Your company withholds 22%, but if you're a high earner, your real tax rate might be 35 or 37%. And that's how someone ends up owing 10 to 15K in April, even though they thought everything was handled. So here's an action item I want you to do right now. Pause everything that you're doing. Log into your equity portal, maybe that's ShareWorks, Fidelity, Carta, so forth. Check your vesting schedule and look at the withholding rate. Some companies allow you to adjust your withholding on RSUs. If it's 22%, plan to sell enough shares to cover the rest and put that cash aside now. Or increase your withholding on your salary income to offset your RSUs. I had a client make $250,000 base salary at Coinbase, but ended up earning $1 million in a year because of their RSUs. This is exactly where tax planning started to feel like a true advantage because he understood the withholding rate Coinbase uses. He knew that it's usually not enough because of his high income, so he sold stock to cover a portion of his tax bill and made adjustments to his withholding. That one step prevented the classic tech employee panic in April. Speaking of traps to avoid, I had another client who exercised a bunch of ISOs when their company got a new 409A valuation. On paper, they made a ton of money. In reality, they triggered AMT and owed almost $60,000 in taxes. The worst part is that they couldn't sell the shares to help them pay the taxes because the company was private. That's the ISO nightmare, and here's how you can avoid it. Number one, before exercising anything, check the difference between your strike price and the company's fair market value. If the spread or the difference between the strike price and the market price is tiny, then that's probably the best time to exercise those options to optimize for taxes. Number three, you might want to keep your exercises small during the year or early exercise so you minimize the likelihood of triggering AMT. And number four, you need to get a tax projection from your tax advisor so you can prepare for the upcoming tax bill. Once you understand the ISO line mines, the next place tech employees leave money on the table is their ESPP. So let's run this with a real Microsoft example. Let's say your base salary is $300,000 and you contribute 10% to the ESPP. That's $7,500 every 3-month window. And let's say Microsoft was $350 and $380 at the beginning and end of the purchase period, respectively. You can buy the stock at $350 thanks to the look back feature, and you'll get a 15% discount from that price. So you're essentially buying shares for $297.50 and selling them immediately for $380 per share. That's an automatic 27% gain guaranteed. And here's where most people get tripped up. A lot of tech workers think the best move is to hold the stock for 12 months so it qualifies for long-term capital gains. In theory, that's true. In reality, with ESPPs, it often backfires, mostly because you're taking risk in the market just to maybe save on taxes. Put it another way, if Microsoft stock price drops during that 12-month window, your tax savings can be easily wiped out by a bigger loss in the share price. That's why I generally recommend selling immediately and locking in those gains. Every type of equity grant you get, whether they're RSUs, stock options, ESPPs, they all have one thing in common. They all have tax implications. And if you don't plan for those moments, the IRS will plan them for you. That's honestly how people with amazing comp packages still feel broke. They're reacting instead of strategizing. So when you actually zoom out, the purpose of all of this planning comes down to two goals. Number one, reduce the taxes that you owe. Number two, be prepared for your tax bills months in advance. That's it. That's literally the whole playbook. When you get hit with unexpected RSU taxes, or trigger AMT on your ISOs, or take unnecessary risk holding ESPP shares, you're fighting against that playbook. When you sell RSUs to manage taxes, exercise ISOs intentionally, and lock in your ESPP gains immediately, you're playing the game the way it was designed. And once you understand that, everything else becomes easier. The real flex isn't having a big equity package, it's actually being able to keep what you earn. If you want a deeper dive, hit subscribe, drop your questions in the comments, and if you want help designing your own tax plan around your equity, that's what we do at Roar Wealth.